All right, what is up traders? What's up tycoons? Super excited for today's video. We got to do a natural gas update. Now, of course, we're going to go over everyone's favorite stock to trade, which will be oil. Now, saying it may be your favorite may be the wrong thing to say, but this is the one that most people are interested, okay? I know a lot of people have been burned by oil. A lot of people love trading oil, but we will break that down. We'll break down UNG as well. Okay, we're also going to break down cold, which in my opinion is the better one to trade if you trade options. And we'll break down why that reason is, but it's simply because of the price. Cold is at 102, all right? And if you trade options, you can get out of the money options, and cold will move more, whether it's to the upside or to the downside. And those options have the chance to gain more because of the way that options work and the different strike prices. If cold goes up 5%, right, and you have call options that are 5 strikes out of the money, okay, then your call options will go from having very little intrinsic value to then being in the money and having a little bit more intrinsic value, versus something like oil. If it goes up 5%, it's not going to move 5 strike prices. All right. Now we will go over the spot price of natural gas. This is the most important chart ever that you can look at when it comes to natural gas. I'll break down why and specifically what I mean by that in today's video. And then, of course, we're going to do, as always, a nice top-down analysis, taking a look at the monthly supply and demand zones, taking a look at the weekly chart, then zooming down to a daily chart, and then a 4-hour chart for natural gas itself, and taking a look at the different natural gas futures. All right. So remember, if you're going to be trying to trade something like oil, you're going to be trying to trade something like UNG or cold, you need to be aware of what the futures are doing and what the futures look like, okay? Those are commodity-based ETFs that are based off of the movements of the futures. There's lots of different decay factors, all right? That's very evident in just taking a look at UNG, right, is making a low and a higher low, and then you look at oil, it makes a low and a lower low. So if you're not familiar with all the different types of decay associated with UNG and oil, right, I have a really great video that goes into very good detail describing the myths and facts surrounding decay and the different decay factors with natural gas ETFs. So you can watch that video, search exactly trades, oil decay, UNG decay, and it'll pop right up and you guys will see it. Okay. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're actually new to the channel, I started a completely free newsletter called Investment Intelligence, and I give out free valuable finance content and free trading content. And I also try to sprinkle in around 1 free trade idea a week. Now, this is what the trade ideas will look like, okay? And we'll highlight the conditions on the chart and show you guys the chart itself. So whether we're looking at moving averages, whether we're looking at resistance levels, support levels, trend lines, chart patterns, RSI, MACD, different things, we'll break down all of that and why it's a high quality setup. And hopefully you guys can learn some of the things that I look for when identifying high quality setups so you can spot them on your own. Now you can go back and review the website for the newsletter. There is a website associated with it, and many of those trade ideas have worked out very well. Now, the reason being is because I'm not spamming you, right? So you don't have to worry about me spamming your inbox with 10 different trade ideas every single day, trying to brag about one that hits. Rather, looking for really high quality setups. And it's about quality over quantity with me. Now, RTX was one of the most recent ones. You can see people in the Discord hitting me up about how their RTX play is up very, very significantly. We wrote about that one in December 28th. So right heading into the new year, that was the trade idea, and RTX worked out very, very well. Okay, if you want to be a part of the Discord, it's only $1 right now using promo code JAN24. Right, these are some screenshots, from the last couple, from the last week or two of different people's profits, trading in the Discord, and you can see, we have lots of people making money, lots of plays making money, and it's a really great community. You get access to all of my different analysis and trade ideas in the Discord rather than just 1 or 2. Okay, now you also get access to other features such as being able to see gamma levels, being able to see dark pool levels, and many other resources. So it's a great thing to get into. Kicking the year off, trying to celebrate the new year, using that promo code JAN24 will get you in for just $1. If you don't want to do that, just sign up for the newsletter for free, either way, I think it's going to be a great value you'll enjoy. Now let's talk about the most important chart when it comes to natural gas. And why do I say that? Well, this is our spot price chart here, and this is a weekly time frame, but it basically encompasses all of the time frame for the Henry Hub natural gas spot price. And this yellow horizontal line here is $2. Natural gas is very attractive to me when it goes below $2 on the spot price chart. Okay, and the reason being is because it always rebounds sometime afterwards. Now, the big question is, how long will it take? If you take a look here, this is kind of when I started covering natural gas, is when it was down here, and it was, I was looking for it to see if it would come down below that $2 level, and it sure did. And it took a while, but it eventually rebounded, right? And so you can see in the very beginning, this was a couple months right here, very short amount of time. Over here, it took a longer time, so I've done a video before specifically covering like the different time periods of this chart. But once it gets below that $2 price level, that's when you want to start developing some type of strategy. Now, again, it could be just a couple months, or it could take a year, maybe up to 2 years for natural gas to recover and get back above $2 on the spot price chart. But that's when I really start to get interested in natural gas and versus just day trading, right? Normally for me, I look at things like oil, UNG, and cold as very short-term trading instruments. And really that's how they're supposed to be meant to be used. And so, I might day trade oil, or I might day trade cold, or do a quick 1 to 2 day swing trade on it. But I'm not looking to hold those, for that time period, like when it comes under $2, not necessarily looking to hold that due to some of the decay factors. If it takes a whole year for things to recover, then it's not going to be too pretty. So there are other instruments. I've dropped so many videos on natural gas. There's stocks that are related to natural gas. All right. There's different types of ETFs you can get into, different things. You can check those videos out as well. But now that we know that, natural gas is almost at that real important level, that most important level that we care about, let's see what's going to happen a little bit more in the intermediate to shorter term. All right. So we're starting off here with the monthly supply and demand zone chart. These are the areas of interest, right? And so, you want to be entering and exiting trades in the major liquidity zones. So the demand zone has been established. This goes back to the history of the beginning of the chart. And you see, each time we come down in this area here, we retest it over here, we test it over here, here, and here. This is a clear area of demand. And in 2023, each time we came down into this area of demand, you saw that there was still strong demand. Buyers continued stepping in and pushing price up higher. But we were battling for, most of 2023, the overhead supply zone, which, originated back here in 2016, 2017, right? And then we came up, we broke out here, failed through it, came up, supply zone again, we broke through, retested it. So old supply became new demand in this case, and we pushed up higher. We were looking for that to happen most recently after we finally eliminated this supply. And so just think and remember that a supply zone is an area where there's an imbalance of sell orders, an imbalance of supply. Now, let's make that even more simple. It means that there is more sell orders on the order book in that area than there is buy orders. Now, remember, each time that it comes into a supply zone and sells off, that means that sell orders are being filled. So then you have to ask yourself the question, are the people who are getting their sell orders filled replacing those sell orders? If they continue to replace those sell orders and replenish them, then that level, that zone is going to stay strong. But eventually you'll get to a point where those sell orders get filled and the supply imbalance is no longer there. And that's what happened. It took most of 2023 for that to happen. But towards the end of the year, you saw that we were finally able to break out. Now, what happened was we wanted to see a breakout retest of this zone and push up higher, and the buyers failed, right? And so we actually fell back below that supply zone, and it's still currently acting as supply right now. So the sellers that were strong over here, they diminished. We were able to push out, but there was not enough demand. There was not enough buy orders on the order book to really keep the price elevated, within this zone and keep it in there, potentially pushing it higher. Now, when we look at the weekly chart, all right, and this is for the natural gas futures again, we talked about how $3.50 to $4 was that target area initially as we were looking in 2023 for the scenarios of where natural gas could go. And the reason being is because it was old demand over here, old demand over here. It never got tested as resistance. We tried to test it as support demand over here, and we just completely blew right through it. So we know from a price action standpoint, if we were going to rebound, we were going to be attracted to this area, to this former area of liquidity. And sure enough, that's what we did. When natural gas had that really strong rally, that really big pump, we came up to that $354 range, and it acted as overhead supply and pushed us back down below. And now we've created a high and a lower high here. So from a weekly chart standpoint, we are in a downtrend, making lower highs, and we really need to see a strong rebound back up to that $350 to $4 range for the natural gas futures to get back into an uptrend, as they were over here, where they were creating lows, higher lows, higher lows, higher lows, highs, higher highs, higher highs, higher highs. Okay, now what I'm watching for any type of clues or context is going to be the MACD, right? Once we had the bullish MACD crossover where the white line crossed above the red line here, that really sparked off the momentum. And ever since there, right at this point, we started to create higher lows, higher lows, higher lows, and we continue to make higher lows ever since we got that cross. We can see that it's chopping around right now, so it's not giving a clear signal. But if this white line crosses below the red line and stays down below there, that's going to be a bearish sign for natural gas. It could potentially push those spot prices back down below that $2 natural gas spot price. Now, this is the daily time frame right here. We have a little bit of what's known as an inverse bump and run pattern. I've covered this pattern a lot on my chart, but basically, or in my videos, but essentially there's a prevailing downtrend, right? So we talked about the lower highs. There's a high here and a lower high here, right? That is your prevailing downtrend. And then we have this aggressive, very aggressive bump down in price. Now we broke out of this trend line, and in a perfect world scenario, this is the run. And so with the run, so we have the bump and run, and the run would take us up towards this first trend line here, which again would put natural gas futures back around that $3 price level. $3 has been that key psychological level. There's a lot of bulls that won't enter into natural gas unless it's at that $3 or higher, and they use that as a psychological level to stop out and to get into, right? So if they get in at $3 and it's above $3, they're going long, and they're using that $3 level as a stop loss. So hopefully, for natural gas bulls, it can rally and get back up to that area, and that'll be an area where there will be some buyers. It's very evident on the candlesticks each time once it crosses above $3. You see right here, wasn't able to close above there. The next day we open and get a strong push above it, right? Same thing over here. Like we fall back down, we dip back down below, maybe people get stopped out, we recover, and as soon as we get right back up above it again, big green candlestick. Same thing over here. We come down, we have a reversal candlestick right here, and then the very next day above that $3 level, we see a big green candlestick, right? Same thing over here. We get above it, big green candlestick. So that's a very important psychological level. Now, if we're looking at our MACD right here, it's attempting to curl to the upside. So if we can get a buy signal like we did over here where the MACD white line crosses above the red line here, and you see we had strong momentum push to the upside, that's something that could be a good signal for bulls on natural gas that, hey, we already broke through the inverse bump and run, and we potentially could have it send us back up to that $3 level. If we get this MACD crossover, that could be confirmation that, hey, we could potentially get the rest of the inverse bump and run pattern to play out and take us initially in a perfect world scenario. It's going to take you back up to where the pattern began, and that's again going to be right around that 350 area for the natural gas futures. Now, when we zoom in a little bit more onto a 4-hour time frame, here we've got divergences highlighted. So if you're not familiar with divergences, we'll break them down for you guys really quickly. But if you use divergences along with the MACD and even candlestick patterns, trend lines, different things like that, you can really start to give yourself an edge potentially when it comes to trading. And what do we mean by that? Well, take a look, all right, at some of the different instances we have. So, in the most recent one, sell signal, right? We have the white line crossing below that red line on the MACD, and we also have bearish divergence. Now, what is bearish divergence? Why do I keep talking about it? Well, take a look how we made a high right here, and then we made a higher high. So price action's in an uptrend here. Price action's actually strong, but the RSI, your relative strength index, is actually losing strength, making lower highs. We have a high, and then we have a lower high. So we have bearish divergence right here. The RSI and divergences on the RSI is going to be what's known as a leading indicator. Now your MACD is something known as a lagging indicator. What that means is that the leading indicator tells you what could potentially happen in the future. It doesn't give you a guarantee. A lagging indicator, such as the MACD, tells you what has already happened in the past. So we're seeing that we have bearish divergence here, that we could potentially get a pullback. And then after we start to pull back a little bit, we see that the MACD crosses over. So our leading indicator said we could pull back. Then our MACD said, hey, we are pulling back. And you see we have a very sharp decline to the downside. Now, most recently, we had some bullish divergence where we had a low and then a lower low. And then we had a low and we had slightly higher lows / equal lows here on the RSI. So now we're creating a little bit of a bullish divergence, and then we had a bullish crossover on the MACD. Again, so the leading indicator is saying that we could go bullish at this moment, and then the lagging indicator is saying, hey, we just went bullish, and you see we had a nice little momentum bread thrust. Now, we did get rejected near the 50% retracement from the most recent highs to the most recent lows, and we got smacked down hard. Now, when you get smacked down hard at the 50% retracement, that's not typically a good sign. And it's typically a sign that you could potentially break down lower and create new lows. So we did get the initial signal for some buys, but it was met with a hard rejection around the 50% fib, not the greatest look. Now, we do have some demand near the most recent lows. So if the futures come back down and test some of the most recent lows, that's an area where it really needs to hold. Otherwise, it's going to go back down into that monthly supply and demand zone, in this case being a demand zone. And we saw in that monthly time frame that buyers have continued to step in each time we've come there. Now, this is going to be the daily chart for Boyle. Okay, just like we talked about that inverse bump and run pattern, we have the prevailing downtrend, then we have the aggressive bump down in price right here. The blue boxes signify gaps. Gaps typically fill about 90% of the time in a market. But when it comes to leveraged commodity ETFs, oftentimes those can be some of the exceptions where, that makes up for that 10% of the time that you never see gaps fill. And the reason being is because if you go, and Boyle has had so many reverse stock splits, if you go and take a look, there's gaps up like way higher than where we're at. It's not likely that we're going to fill those gaps ever. Now, if we do get a strong momentum thrust here, right, we have a gap up to 65 and we've got one up to about 58, 59. Those are going to be, your best case bullish scenario here over the next coming months is if we can come up and fill those gaps. Again, that would take us up towards that inverse bump and trend line, right, and the targets for that. But there's a lot of work to be done. Currently, we've got some demand here. Okay, we established a little bit of demand, and we've got overhead supply, which is going to be right around 36 to about 39. Okay, that is your overhead supply zone, and then we've got our major Fibonacci retracement levels here. So what this means, okay, we talked about the futures and how we got smacked down at the 50% fib right here. Well, we're taking the most recent highs, the most recent lows. If Boyle was to rally, we need Boyle to get above 31.66, but really we need it to get above 33.82. Okay, above 33.82, we do have that supply zone we talked about. But even if we reject that supply zone and come back down, if we can hold above 33.82, that's going to be a very strong sign that we're going to get 100% retracement back up above the 40s and potentially really start to rally and try to come back up to the 50s or 60s. So, shorter term, yes, we can rally if we can find demand in here. If we break below 23, 1762, 1507, and 1140, those are going to be your next big support levels, and it's most likely going to get there quickly. Now, we talked about bullish divergence, okay? There is a bullish divergence on Boyle. Now, remember, these charts, these ETFs, they can have their own charts and their own signals, and you can use them. But you also need to pay attention to the futures, right? So at the moment, we have a bullish divergence here on Boyle, where it created a low and a lower low, and then we have lows here and higher lows here. If we break this bullish divergence trend line, that's definitely going to coincide with us breaking through demand. And again, we're going to be heading down towards 1762. But if we can continue to hold this trend line and bounce here, then that's when we would look for us to potentially break out of this inverse bump and run trend line and head up to that 31 to $33 price levels. Those are going to be very strong resistance levels. And if we can do that, we know we've got a small overhead supply zone just above there. And, if we can flip all of that to some type of support from resistance, then we have a good chance of heading back up to the 50s or 60s. But lots of work to be done in the meantime, as I just described. Now, UNG looks different, okay? Here we've got a very strong downtrend right here. You could call this a little bit of a falling wedge if I was to draw another trend line right here. And UNG's got a small gap up right below 21, and it's got another gap up to fill at 26. Okay, so if this falling wedge was to break out right here, 26 is a reasonable target to the upside. Now, of course, we've got the Fibonacci resistance levels here as well. So that's going to be 22.49, 23.45, and 24.41. Those are going to be your major areas of resistance if we do get a breakout that you want to pay attention to and be cautious that we could come down and see some type of negative price action. So pay close attention to that and those levels. Those are going to be the key levels that you want to pay attention to and watch when it comes to UNG. There's no bullish divergence at the moment because we're making a low and we're making higher lows right here. So we're not, diverging. We have lows and higher lows on the RSI here as well. All right, now cold. Cold, as I mentioned, is if you're an options trader, this is the one that I think you should be trading, because it will pay better in the option strike prices movements. Now, we've got a pretty strong uptrend that we're in here. And if natural gas can find some footing and, we start to see some of these other things like BOIL and UNG start to go, and maybe they break out of their inverse bump and run, maybe they break out of that falling wedge there, most likely that would coincide with cold breaking down of its recent uptrend. Now it's got a gap down to fill at $90 and it's got another gap down to fill at $79. So those are going to be some of your first targets. Now we've been talking about Fibonacci resistance levels. With cold, it's going to be Fibonacci support levels, right? It broke its most recent downtrend, had a strong move to the upside, hit the first bullish target. And if we can break this trend line, the first area of support is going to be 93.74. Then we've got 88.29 and 82.84. Now, these are going to be areas where you may potentially want to go long, right? And it's going to set up a really good risk to reward ratio trade if you do at some of those levels. I know people may not want to hear that, especially if they're long natural gas and cold is going to be bearish. But the reason I say that is because we've got an anchored VWAP up here, okay? And we've got an anchored VWAP down here. These are the most recent lows, and then these were the previous highs. And so what this means is that the average buyer and seller, the average buyer is above right here, okay? So they're up on their prices. The average buyer from the highs and the average buyer from the lows, both of them are up. And the reason that I think that it could be good opportunities is because look at where the anchored VWAP is from the highs. It's right at the 50% retracement level. And the anchored VWAP from the lows is right at the 61.8% retracement levels. So again, just from a standard risk to reward standpoint, if we were to come back down to 82, 84 on cold for some reason, okay, you could have a stop loss just below this gap because you know that this gap could fill. So you can have it just below that gap, okay? And then you would look to target back to 110. That is going to be a really good risk to reward ratio where you're risking about 5 or 6 points to potentially make about 20 points or 30 points. Those are high quality trade setups, okay? And then, if it drops down and hits your stop loss, you take the stop loss, you eat it, but it's a good 4-to-1, 5-to-1 risk to reward ratio, with that type of, setup right there. So, that's something that I'll be a little bit more interested in is, if this does break down. Now, if natural gas remains bearish and cold remains bullish above 110.82, cold can come up to 123 and 139. So, if we were to break out above 110, then you can also have, some good risk to reward ratio there with entering in some longs and then setting a stop loss below 110.82 because we know that's the key level that we really want to hold. And above there, cold is bullish, heading up to 123 and 139. And those are good areas as well that you can set up, nice risk to reward trades. So that's pretty much it for natural gas. I had a few people been asking for updates on it. I didn't really cover the news or any of the macro things surrounding it or storage and things like that. This was much more of a technical analysis. Within the next week, I will try to cover, some of the macro stories and some of the headlines that are more important to natural gas. If you enjoyed today's video and you enjoyed the analysis, you're really going to love the Discord, okay? I post over 20 swing trade ideas in there every single day. or not every single day, but there's over 20 swing trade ideas a week posted. DraftKings was one of the most recent ones. You can see it's dated January 13th. We're talking about how every February, heading into NFL playoffs and the NFL Super Bowl, February has been historically bullish for DraftKings. It's been green 100% of the time. On the daily time frame, we had a falling wedge, and you can see after breaking out of that falling wedge from when it was posted, the stock went up over 21%. And that's very, very profitable, not only on shares, but if you were trading options on those things went up a massive, massive amount. So remember, promo code JAN24 will get you into the Discord for only $1 right now. But that's going to be ending at the end of January. And if you don't want to pay for anything, the newsletter is completely free. You can sign up for that. Either way, it's going to be, you're going to be provided with good value. And that's all I'm looking to do is just provide you guys with some good value. If you enjoyed today's video and, you want to go over some of my day trading dynamics, swing trading strategies, different things like that, you can click on the commissions tab on my Ko-Fi page. There's a link in the description for the Ko-Fi page. In there, you can book a 30-minute session, a 1-hour session. I do lots of coaching sessions. Over the past year, I've had countless people hit me up about natural gas, and go over some of their positions, how they can hedge their positions properly. What are some ways that they could use options to leverage their positions or hedge their positions, many different things. There's also this little buy a coffee button, basically a way to leave a tip or donation for the free valuable content that I do put out there, such as these videos and the newsletter and other things. So appreciate you guys watching, and I'll see you in the next one.